Hi. So Titan is one of the largest consumer durable companies in India, and with a market cap of 4 lakh crore operating across different business segments like jewelry, watches, eyewear. It's a fascinating business to analyze. So we recently conducted a webinar trying to kind of evaluate the financial statements of Titan, look at what its competitive advantages are, what segments contribute how much to the business, and where does the profit really come from to understand its business model. So the video of that webinar is next. Follow along with us till the end and try and work on the financial statements of Titan on your own as well. Do subscribe to the channel if you haven't done so far, and do share your feedback on the video as well. All right, so in this discussion, we are going to talk about the financial analysis of Titan. We are going to try and look at its annual report, parts of that. We will understand what business they are in or what businesses they are in, and we will try and evaluate what's the numbers look like, and why are they moving the way they are moving? Has the management told anything about it? What follow-on questions do I have about the business, and so on and so forth, right? With respect to the understanding of this, please remember that this is not a recommendation to buy or sell a stock. This is purely educational endeavor to understand what is going on with the business and how do you really go about analyzing a business and its financials. So that's what our objective would be during this particular discussion. First things first, we just need to understand from the purview of a business like Titan as to what is it that it really does, right? What's the real claim to fame for somebody like a Titan? Most of our understanding of Titan as a business starts with the purview that this is a watches company, which was true till about 1995, 96. A lot of us may have seen the series as well, which predominantly talks about the watches segment. But now the business of Titan is significantly beyond that. And the largest business for Titan at this point of time is jewelry, right? So let's just understand the landscape first. So if you look at what all does Titan do and what are all the diverse lifestyle segments or brands that they are into jewelry, they are into watches, they are into eye care, they are there in fragrances and women's bags, Indian dress wear, and other accessories as well. And within that, they have segmented themselves into luxury, premium, mid-market, mass market, and licensed brands as we kind of look at them. So there's a purview that comes along with those segments and where the categorization of each of them would have happened. Even within that, they would have very clearly defined, for example, in the watches segment, they would have clearly defined sub 10,000, 10,000 to 25,000 price point, 25,000 to 1 lakh price point, 1 lakh to 5 lakh, and beyond that, essentially. So their segmentation would base the price points of what is happening. The largest segment, interestingly for them, where nearly 90% of their revenue essentially comes from, is the jewelry segment. Tanishq, as we are aware of, is their core brand, under which now there are a lot of other sub-brands that have started coming in as Zoya and, Carrot Lane, which they acquired, Damas that they acquired, Mia, and there are a bunch of other segments that you come across, right? What you could also segment them, and this is available in the annual report. So if you go through the annual report and try and find a word for segment results, you will see segmental results of revenue and profit and loss, consolidated revenue that you see. And you will spot that out of the overall revenue of about 88,000 crore, nearly 79,000 crore comes from jewelry, right? The second largest segment is watches, which is at 5,200 odd crore. And eye care is separately listed, but all the others put together, which includes your fragrances, women's bag, Indian dress wear, and a precision engineering segment as well. All of that put together is about 2006 crore that you find, and eye care becomes about the fourth one, which is 916 crore. So that's the sense of what all they do at this point of time. Now, if you step back a little bit and try and understand from the purview of this business as to how are they positioned, and you look at their segments of the businesses that you're looking at, one of the primary thoughts that you would come across would be the idea that if you pick up each of these segments, these are largely unorganized segments in India, right? For example, jewelry as a segment, even today, is it's probably a $90 billion size or revenue segment every year in India, right? And 60% of that is unorganized. and the remaining 35-40% is organized. Out of the organized players, Titan has the largest market share, right? Of the organized players, Titan has the biggest play that exists. If you were to use a USD INR number of about 95 or 96, you'll probably see $8 billion worth of revenue that they have in the overall jewelry market. So organized segment, they are the largest player with roughly about 20% odd market share. Unorganized, organized put together, they still have a high single digit market share that they kind of hold in the jewelry segment. So reasonably strong business, but there are two clear levers that are available at them. One is the shift from unorganized to organized. At this point of time in the jewelry segment, roughly about 60 to 65% is unorganized, and the remaining, which is 35 to 40%, is organized. So there is a clear shift that is happening from unorganized to organized purely because of trust, economies of scale, the ability to kind of run that business, and so on and so forth. And the second clear mechanism is gaining market share within that segment. So how big can the company grow? Is the company growing at more than what the organized segment is growing at? So those are the two parameters you would want to kind of evaluate year on year. As I said, roughly the jewelry market in India is approximately 90 to $100 billion. This is, by the way, expected to go up to about 140 odd $billion by the time we're talking approximately about 2030 or so. Some estimates peg it higher than that even before that. But that's partly to do with the higher demand and partly to do with the fact that people assume gold prices also to go up. So that's the construct. If you visualize what Titan is doing, Titan basically picks up an unorganized segment and tries to become the largest organized player in that segment. That's what Titan seems to be kind of working on. You pick up jewelry, you pick up watches, you pick up eyewear, you pick up fragrances, Indian dress wear. Almost all of these are predominantly dominated by the unorganized segment. Localized regional players will be strong in this, but over a period of time, you will kind of come up and look at this data, right? So that's the context of what we are looking at with the purview of the details that we have, right? Now, let's dive into the financials first and look at that data as we kind of go along and work with that. So if you look at the data for Titan, first things first, when you start understanding a business, it's always a good idea to quickly take a look at what is the size scale of business of operations. So market cap about 4 lakh crore or so. And there's a bunch of data that is available anyway on the screen or website. But more importantly, if I just go and quickly look at the P&L statement and try and understand what kind of growth has sort of played out there, you'll see there's a massive spike in growth that has happened over the past few years. I mean, 5 years sales CAGR is about 32%, 10-year CAGR is about 23%. Now, part of it is unorganized to organized, gaining market share in the organized segment, and so on and so forth. Part of it is also gold prices jumping up. So volume may have grown at a certain rate, but the value itself has kind of gone up because gold prices continue to spike up. So that's one of the key elements that we have to kind of look at. Profitability about 9-10% operating margin. A few years was higher, dipped a bit last year, has spiked up again in 2026. That's the construct that we see. You also see profit numbers. So you'll get a 10-year profit CAGR of 22%, 5-year profit CAGR of 40%, and so on and so forth. If you quickly just skim through the balance sheet, you will see about 60,000 crore of total assets or total liabilities. And when you visualize the 60,000 crore number, you'll see a bunch of borrowings here. I'll dig into borrowings as we go along. Other assets are very large. Fixed assets are lower. Other assets would be large because this is a gold jewelry business. You would anticipate inventory to be a major number. So that's a very large number on the inventory side of things. We also need to understand how do you sort of manage the inventory risk. We will come to that as we discuss the numbers. What we have here is an Excel file now, which has all the major numbers pulled out from the P&L and balance sheet for the past 4 years. We are going to do some calculations on this and try and understand the numbers as we go along. As we kind of do those calculations, I'll keep sort of talking about some of the ratios. key point here, the definition of the ratio is not the very important or most important part here. What is important is your interpretation. As long as you are consistently and uniformly applying a certain definition to the ratios, that's okay. Just have a logic of why you're using that ratio definition and apply it consistently across the history of a business or multiple businesses that you are comparing. So we're going to do that. Here there is a P&L and a balance sheet data that is available. On the P&L, the way it is reported, you do not find the EBITDA or operating profit numbers, right? So if I go on ratios and I look at the sheet, and let me just sort of increase the size a bit so it's visible. I'm going to kind of write the formula of every ratio in the formula column, which is column B. It's not that you have to restrict yourself to only these. You can basically add more ratios as you go along and then build on that as you kind of construct this, right? So that is the contour of data that we have. That is the set of details that we are going to look at as we calculate some of these metrics. Let's start with the first one, EBITDA margin. You will see it'll be EBITDA upon revenue from operations. But one of the problems you will find when companies report their data is EBITDA is not directly reported. You get total income, you get total expenses. Expenses include finance cost and depreciation. So what you get is profit before tax. You don't really get EBITDA essentially. So you have to calculate or back calculate EBITDA. So we've done that here. Now, EBITDA essentially is your profit before share of profits of associates, etc., and before tax. So this is net PBT plus depreciation plus finance cost minus other income, right? You could also calculate it the other way around, which is take revenue from operations and subtract all the other major costs that exist. So you get to an EBITDA number basis that. And I have calculated EBIT as just that number, PBT plus the finance cost. So EBIT includes other income in my calculations. You can choose to remove that in your calculations. That's your choice. If you're removing other income, it's just EBITDA minus depreciation is what you will get. This EBIT here includes other income for the purpose of my calculations. Once again, I'll repeat, it is not important that you agree to what my formula is. Whatever your formula is, have logical reasoning for that and consistently and uniformly apply that across your breadth of universe that you are looking at, right? I have used this EBIT. So these numbers have been calculated here on EBITDA and EBIT. For every company that you use, you will basically go about looking at that calculation. Now we go to the ratios number and we calculate EBITDA upon revenue from operations. So I'm going to take 2023 equals to EBITDA divided by revenue from operations, which is 40,576 in that year. We get a number converted to percentages, right? And let's change the font for some reason. This is, let's put it this way, right? EBIT upon total revenue is, now I'm using total revenue, remember, because I said we have to apply it consistently. If you include other income in EBIT, because it can be used to sort of pay your interest cost, then I will use total income. Net profit should also be on total income, right? So if I use the net profit number and I take this and take the profit for a year, I divide it by total income because net profit includes other income as a component. Percentages, let's put this way. So we get to a construct around this and we have calculated the data as we kind of go along, right? So that is the difference that we kind of see. Just for the uninitiated at this point of time, a very quick discussion. EBITDA is earnings before interest, tax, depreciation, and amortization. EBIT is earnings before interest and tax, knocking off depreciation from that. So if you are looking at the profit and loss statement of any business, the way it gets constructed is you will start with sales or revenue from which you will remove operating costs. So you will arrive at a measure of operating profit. In India, most companies and websites treat EBITDA as operating profit. Globally, a lot of textbooks will talk about EBIT as operating profit. From this, you subtract depreciation and amortization, which is basically the expense accounted for the gradual consumption of assets. You get to earnings before interest and tax. You subtract interest. You get to profit before tax. You subtract taxes. You get to net profit. That's how a P&L is structured. So we are looking at margins at this point, we are looking at margins at this point, and we are looking at margins at this point, essentially. Those are the three elements that we have calculated. Those are the margins. So in simple terms, what we are trying to identify is per 100 rupee of sales, what is your profitability number? So you're making 12 rupees of operating profit, you're making 11.6 of EBITDA on 100 rupees of total revenue, and you're making 8 rupees of PAT margin on that. So that's the construct that we see in those particular years. We will drag it ahead, of course, and try and understand what the numbers have been. So you'll spot something interesting, that your margins have basically gone down from 2023. They went down all the way up to 2025, and then they have gone up a little bit, right? Now, one part of it is the calculation, as I said, which is the easy part. This is what we have done. But for most practical purposes, it's good to do it, because then you get the questions in your mind while you're doing it. But you could also get this derived from a bunch of software that is available. You can basically put the numbers in one of these LLM tools, and they can calculate the ratios for you as well, given a certain definition. But I would suggest that definitions are to be given by you, right? Now, the construct that you want to do ask is, why is this happening? Right? Why are margins going down or going up, and so on and so forth? And that's your key question that's going to kind of come up when you are trying to evaluate this business. Calculation of ratios is the easy part. Now comes the actual analysis part, as to understand why is this happening. So we'll go to that in a bit. Let's first calculate all of the numbers that we have with all the formula that we are using. I'll explain definitional points towards the end as we go along. Just be with me as we go along, right? Now, return on equity, as we know, is actually calculated as net profit divided by total equity. ROCE, on the other hand, will be EBIT upon equity plus debt. There's a small nuance in ROCE calculation, which I'll arrive to. We'll take total debt upon equity in debt to equity. EBIT upon interest is going to be, or let's put the number finance cost as our interest coverage number. I will use in all turnover ratios, I will use sales in the numerator. So I'm going to take sales, or let's put revenue from operations, and divide that by inventory. You can use averages if you want in all of these calculations, average inventory and so on and so forth. I'm going to keep it simple for now and keep it year-end numbers, total assets. And then we will go to cost of materials at some point as we go along. So let's calculate all of these numbers one by one. There are a couple of numbers where a nuanced approach will be needed. And in the process, I will explain to you what is really going on, right? So let's calculate ROE, and which is why I actually recommend that you punch in numbers on your own, even for balance sheet and P&L, even though software can do it for you and you can download those numbers and so on and so forth. Because when you punch in numbers, or you're calculating these ratios yourself, you will come across a certain questions that will come to your mind. So ROE is straightforward. I can just take the profit, net profit number, and divide it by the equity number for the year. Equity is available here, total equity. So we'll see this, and so on and so forth. Now, there is an interesting spike that you see in this number over a particular point. Let's actually do one thing. Let me, for simplicity, select all of this and change the font here itself. And let's increase the size of this, so we have a clarity on this. So 27% jumping up to 37%. We'll come back to this as we go along. Why is this jump happening, and then the dip happening, and then the jump again happening, right? You could decode ROE using something called as a DuPont analysis, but we'll leave that aside for now. We'll come back to that. ROCE will include a bunch of things, equity plus debt. Now, again, a lot of textbooks tell you that you use only long-term borrowing in ROCE. I prefer using total borrowings. Right? Again, you don't have to agree or use only that formula. I take it because firms can sometimes tend to use this interchangeably. I want to look at all interest-bearing debt in some form or fashion. There is also another adjustment we will have to do to this. So we take the EBIT, we divide it by borrowings, financial liability, and we divide it by non-current liabilities that are there, right? And I close bracket and I calculate it. So you get a absurdly large number, because they don't have too much borrowings and and the numbers basically appear on that construct purely because of low debt. But when you start looking at their borrowings a little bit carefully, one, this number may change across the years. So even if I were to drag it across, you will see it changing. But something that you will spot cleanly on your balance sheet, if you pay a bit of attention, first things first, you will get some numbers called lease liabilities, which are relatively higher. Now, this is a particular year where there was no long-term borrowing, then there was some long-term borrowing in subsequent years that had come in. Short-term borrowing was also 2,000 odd crore, which over a year or a period has gone up to 11,000 crore. There are two line items that are interesting here that you would want to pay attention to. One is these lease liability numbers that you spot. They would be interesting. So I'll explain where they come from. The second is something called as gold on loan, right? This is also something that I will explain as we go along. Now, when you calculate debt metrics, you can use gold on loan or you can ignore gold on loan. Use it consistently. Let's first talk about the lease liability context. Now, what has happened post 2020 is there is a accounting rule called Ind AS 116, which basically says that all your operating leases have to be converted into financial leases. I will explain this in plain English. If I have a store that is rented, that's an operating lease. I'm paying rent on it. Accounting standards mention that you have to assume that you notionally borrowed money and you notionally bought this asset or this store. For all practical purposes, this is a notional accounting entry that is happening. You're actually paying the rent, but you're assuming that what if I had borrowed money and bought this? So when you had borrowed money, that notional money that you have borrowed will appear as lease liabilities. And the asset that you have bought notionally will appear as something called as right of use asset. That's here on the asset side. You have to kind of put something on both sides of the balance sheet, right? Right of use asset and notional liability like the lease liability on the other side. What this has done effectively is, more importantly, if you understand what used to be a rental expense earlier, right? So rental expense will be above the EBITDA line item. If you go here, rental expense is somewhere in the operating cost. That's where it is coming. You have now converted that rental expense instead, because you have assumed a financial lease and you have assumed a borrowing, notional borrowing and a right of use asset. You have basically converted it into depreciation plus interest. You reclassify it. See, if I had rented a place, I'm paying rent on it. If I assume that I borrowed money to buy that place, what I bought, I will have to depreciate, and what I borrowed, I'll have to pay interest on that. So notionally, I will take the rental expense and reclassify it in the form of depreciation and interest. There is more nuance to it. It's not like for like. So if the rental expense is 10,000, your depreciation and interest won't add up to 10,000 in that year. But if rental expense over 5 years is 10,000 each, then the depreciation and interest for that 5 years on account of these notional assets and liabilities will add up to 50,000, right? It could be a little bit up or down. Now, what this does is it distorts your numbers a little bit, right? In this business, it may not, but if a business has a lot of lease rentals, like airlines or like a retail chain that does not own the stores, what is effectively happening is the cost has been reclassified here and here. You take out the rental part from the operating expense and you put it in depreciation and interest cost, and that distorts the margins because margins go up. So technically, your EBIT is marked upwards because the rental expense has not been deducted. Because your EBIT has gone up, you understand, if there was 100 of rental expense here, that 100 has now gotten reclassified into these two line items. So my EBITDA goes up, and consequently, because I've not removed the interest here, my EBIT also goes up optically. Actual number is lower, but I'm just accounting for it that way. Because EBIT has gone up optically in the numerator, if I'm using a ratio that has EBIT in the numerator, the denominator should therefore include the cause for that. Numerator has gone up, so denominator should also be adjusted accordingly. So I will add the lease liabilities also into this. So I'll go to the lease liabilities and I'll add the lease liabilities here as well. Long term and short term, enter, you get a number. drag it ahead. Now comes the second and more interesting part of the business, which is gold on loan. Now, imagine a jewelry business. The biggest risk for the business is inventory and the prices of gold on the inventory, right? So what major players like Titan do is essentially they will borrow gold from bullion banks globally. So they borrow gold, and the rate for borrowing is it's a secured loan because it's secured against the gold itself, and you are borrowing grammage or weight of gold. So let's say Titan borrows 1 kg of gold. Now the gold appears as inventory, so it's an offsetting transaction. On the balance sheet, you will find gold in terms of the inventory as well, right? But a lot of this is not purchased. So there are two ways you can run this. Either you borrow money and then go and purchase gold, but then you run the gold price risk and you run the currency risk. Remember, gold in India is denominated in INR, but globally the gold prices move in dollar terms. So not only are you open to gold price movement risk, you're also open to the rupee dollar risk that kind of comes with it. Because both of these come to the picture, you want to eliminate that hedging cost. So one way to run the business is I borrow money, I buy gold, I keep inventory at my end, I hedge the dollar rupee rate, and I hedge the gold price, and I run with this. Smaller jewelers keep some of these risks open. So they make a lot of money in a rising gold price environment because they bought gold earlier and now they are selling at the price on that particular day. But it is a risky strategy because if the gold price starts going down, then you may have bought inventory at the wrong point, and then you have a sustained down move that can create a little bit of a problem in terms of your profitability. It's not a very high margin business. It's eventually a 10-12% operating margin business. So if gold prices move by 10-12% and you are keeping that inventory unhedged on your books, there is going to be a problem. So everybody will have to hedge. Now, there are two ways to hedge it. Either I say I will buy gold by borrowing money and then run a working capital cycle uh, and hedge it myself. That's one method. What Titan does instead, and some of the larger gold players have now started doing it, is they would go to these global bullion banks and borrow gold itself. So they'll borrow 1 kg of gold and they'll say, I'll return you 1 kg of gold. When would you return? When you get an order. On that day, basically, you can match it again. So the gold price risk is sort of gone. And the currency risk also in that context is sort of gone because now what you've done is you've run this on an asset light model. Now, what interestingly also happens, you will note, is if you go to their annual report, and I'll show this to you as well as we go along. If you go to their annual report and you look at the numbers for gold loan and finance cost because of that, you will realize gold borrowing for them, given their credit history and the fact that this is secured borrowing and it is against the gold, you will return the gold eventually. That borrowing is happening at somewhere around 3%. Right? So technically think of this 3% as the hedging cost versus the hedging cost. If you were to hedge, the hedging cost would probably be higher. Here you're getting gold from a bank, a global bullion bank, and all the global major banks would basically operate as bullion banks and they would kind of give this. You take it on your on loan, you run your business with that. When you get the money, at that point you return the gold. You've borrowed gold grammage, you will return gold grammage. So gold price movements kind of go out of the window. Titan also runs a massive gold exchange scheme. So if you have jewelry at your place, you can take it to Titan, you can give it to them, they can take that gold, and at that point of time, they can choose to return the gold on loan to the bank from where they have taken this. So that's a bigger number. But in a sense, if you think about it, for everything that you have to do with Titan's debt, you have to kind of visualize both metrics, which is debt and lease put together, and debt plus lease plus gold loan put together, right? So gold on loan put together, which is this number. This is a fairly large number, but think of it as an offsetting number against the inventory. The other option, as I said, you could have taken short-term borrowing and bought gold with that, in which case this would have gone up, but so would have hedging cost gone up. This is a cleaner method. And you see this number also increasing because gold prices have gone up, right? So that's the construct. But in all practicality, you can sort of think of this 16,000 as a netting off number against this 42,000 of inventory that you're holding on your blocks. We're talking largely about gold because 90% of the business is that only, right? You don't run as much inventory and so on and so forth for others. Maybe that changes in 10 years. So we will look at that as we go along, right? So that's the construct. I will keep that out of here. Even when I'm calculating debt to equity ratio, I will assume total debt only. Here I'll ignore the lease liability part as well. And I will calculate the debt to equity number. And then we will see if we want to add gold loan and then gold on loan and that as well, right? So debt numbers here, I will take both long-term and short-term debt. Let's quickly take that. This is long-term borrowing plus short-term borrowing, which is this. And we divide it by total equity. We get a number of debt to equity, uh, right? And interest coverage is EBIT, which is calculated here, divided by the finance cost, which is here. So that's my interest coverage number that we calculate. Uh, Debt to equity, interest coverage, let's put it here. Let's do this. Sorry. Let's change the fonts to what our common fonts were. And we have the numbers. Debt has gone up, obviously, because of the premise of higher gold prices and higher inventory. We go to inventory turnover now, which is revenue from operations. I'll take revenue from operations, divide the inventory. Again, as said, you can take average inventories, right? Revenue from operations on the P&L, which is here, divide by my receivable number, which is trade receivables in current assets. Not a very large number, B2C business, right? And total asset turnover is again revenue from operations divided by total assets. You can take total income as well here because your assets include cash, etc. as well. So here is my total asset number. So I get these three. Let's quickly do this. Calibri, try it here. So we get this. Right? Receivable turnover is a large number because it's a B2C business and there is no real receivable that exists for the business or very small amount of receivable corresponding to the size of their business. Total asset turnover you will see is almost sort of equivalent over that year. It has not really moved too much. Inventory turnover seems to have gone down a little bit. Inventory has gone up because gold prices have gone up. So there is not a like for like play there. Just the fact that gold prices have gone up and you're trying to kind of keep a little bit of gold ahead of festive season would typically in this kind of a period create these. There's also a seasonality factor that can impact this in terms of why is inventory higher and so on and so forth. Um, uh, this year, for example, Akshay Tritiya, which is a festival in India, was earlier. And so they had to kind of account for buying gold earlier and keep inventory higher. They have explained this in some of the con calls as we go along. And that question should come to our mind as to why is this happening? And once that question comes to our mind, automatically you'll try and find for answers that why did inventory increase in this year as such, right? I can calculate these as straightforward numbers, raw material as cost of sales. Now, when we look at raw materials, it's actually the sum of three numbers, right? Which is on the P&L. On the P&L, you will look at these three numbers: purchase of stock in trade, cost of materials, and changes to inventory, and divide it by revenue from operations. That's this cost. This will be in percentages. I'll do that in a bit. Employee cost as a percentage of sales on the P&L. I go look at the employee benefit expense divided by sales, and other expenses, P&L, other expenses divided by revenue from operations. So all of these come up, percentages, and I drag it on the right side. So that's the construct. I can ignore this. So that's what you get. Raw material cost has gone up as a percentage of sales. Why has this happened? Why? Which is basically the question on why is margin declining and your understanding of that as you kind of go along, right? Now, the intuitive bit that we have to understand is these are multiple businesses rolled into one. So I can't get an answer to this straight away. I can't get an answer to this straight away unless I have an understanding on these parameters. So the construct of this has to be understood from the purview of segmental revenue, right? So there is a sheet here on segmental results. As I said, Titan reports this. We saw it on the annual report data. They give you the revenue and segmental EBIT. So this is segment EBIT, which is available. So I can get the segmental EBIT margins here, right? So I can basically just copy this entire thing here, let's say, and paste it here. And segment EBIT margins is what I will look at. And all that does is divide jewelry by jewelry, and I sort of calculate it across, convert it to, one sec. I have to pull it here, pull it down, convert it to percentages, and see the number accordingly. Right? So we get these metrics that are there. Ignore the unallocated bit, ignore this. This is not needed. We can remove the segmental results and all of these details as we look at. Let's add a couple of decimal points here. Right? And you will note that the segmental margins would give you an interpretation of what is really going on here. And we see jewelry margins sort of declining. Interestingly, watches and wearables in the last 2 years has gone up. So your questions again will be, why is this happening, and why is this happening, and why is this happening? Right? Why are these margins going up or down essentially? So I'll explain this. This is given in their conference call transcripts. People would ask these questions. When you're evaluating it as an analyst, you will kind of go and look at these numbers and understand. Others is also interestingly growing. I think this is just economies of scale that are playing out in this segment. Now, one more thing you have to understand is Titan actually reports this data this data that you see, which is their total jewelry segment data, which if I were to just do a segmental calculation of these numbers, let's freeze this and calculate where is it coming from. Bulk of the revenue actually appears from uh, jewelry, correct? And ditto I can do for the calculations of EBIT as well. The construct then is to understand what is happening with jewelry even when gold prices are going up. So now they have given some interesting explanations to this. One part of this is essentially there is something called as bullion, which is they buy and sell gold directly, right? So that is what is to be constructed and looked at. Okay, so Titan does a bunch of bullion activity, which is basically they buy and sell gold straight away. Now, if you think about it, why would you do bullion? Is customers do a lot of gold exchange, right? I can take old jewelry to Titan and say, why don't you give me new jewelry against this? So because of this bullion, they get old jewelry and they will basically, they don't want to keep it on their books. So they will sell the gold on the same day. This is a margin neutral business. There's no margin. You basically get, let's say, 5,000 crore of gold, you'll sell 5,000 crore of gold. But what this does is it allows the customer to walk in. And because the customer walks in, the customer will obviously end up purchasing something else from the margin accretive business. So interestingly, Titan also reports the jewelry business ex bullion, which is just pure gold buy and sell, right? You will note the EBIT doesn't change because the jewelry bullion business is basically you buy 5,000 crore of gold and you sell 5,000 crore of gold, correct? So you should ideally exclude that and then calculate the value there. In this case, there is no fluctuation because you buy it the same day, you sell it the same day, right? Or you return the gold loan on the same day. So essentially, there is no clear fluctuation of gold prices in this context. Whatever price you bought it at, it's an exchange scheme in that context. And whatever gold you're holding, you will sell it to somebody else on that day. So your margins that you're calculating will therefore be a function of X bullion data. They give you the X bullion data. So you can calculate that. And when you look at X bullion data, right? And if I calculate this and I do this, let's convert it to percentages. Let's reformat. You will note that while that number went down the previous year, it's gone up again this year. Now, why did this go down in FY25 is gold prices shot up quickly. Because gold prices shot up a lot in that period over the last 2 years, at some point of time, the prices have shot up. When gold prices go up, people stop buying gold jewelry. They instead start buying gold coins, right? Just to sort of, they sort of reduce the gold jewelry purchase, at least intermittently at that point. You make more money on gold jewelry because your making charges, etc., is where the margin lives. Gold price is a buy and sell thing, right? So your margins, they actually report that also in their investor presentations for gold coins as well. Gold coins would operate at a lower margin than a gold jewelry. If the proportion of gold coins increases in the business, then the margin goes down in that year, right? But if the proportion of gold jewelry increases, the margins sort of move up again. So if there is a sudden movement in gold price either direction, it starts impacting the consumption profile. Also, interestingly, if you note about it, let's say there is studded jewelry which has diamonds in it and gold in it. Diamond part is more margin accretive than the gold part, right? So if gold price goes up, suppose earlier you had a jewelry piece which had 100 rupees of gold and let's say 30 rupees of diamond in it. Now, if gold prices have gone up, this becomes 130, this remains 30. So suddenly the proportion of gold in the jewelry increases. That is a lower margin product than diamond jewelry essentially. And so consequently, optically, the margins sort of decline. So it's a bit counterintuitive. If gold prices go down, for example, this number will again go to 100. This will remain at 30, and then your margin profile shifts again. So you do not read too much into this margin dip and margin going up, because this is just a function of consumer preference in that small period of time. But you do need to decode this. So the skill in analysis that you will try to develop lies in identifying this movement and then saying, is it important or not important? On the face of it, margins have fallen, but why have they fallen? Have they fallen for everybody else as well? And is there a logical, rational explanation for that, looking at what's happening to gold prices essentially? So that is the construct that you have to keep in mind when you're evaluating some of this. They've given almost all of this rationale in the financial statements. You can actually go and check their annual report. Very detailed annual report. They've given a very detailed investor presentation along with that as well. So if you look at details around this, uh, you will see, let's actually quickly run through this. I'll show you some interesting aspects of this. They give you the overall numbers. These are standalone numbers and how many stores do they have. So you could actually find out revenue per store and use that metric as well. Although that's not very helpful in this kind of a business because of the fact that your predominant amount of money is coming from jewelry. And so either you segregate and say how much is revenue per store on jewelry and revenue per store on eyewear and revenue per store on watches, right? Otherwise, on an aggregate basis, it may not be very helpful. This is the screenshot I had shown you. They give you a bunch of data points about what is happening in the business. You read through it. They talk about their business segments in a lot more detail, right? So if you actually go further in this annual report, you will see almost all the business segments that we'll talk about. So you start with business segments on this slide, page number 33. They start with jewelry, talk about what has been the jewelry business, excluding bullion sales, what is the consolidated income, what is the growth. This was driven by this thing, continued premiumization and elevated gold prices, all of that put together. You can explain retail network, what are they trying to do, what stores are they opening, in what segment they are opening. Customer shift also when gold prices go up happens from 22 carat to 18 and 18 to 9 carat. So those categories start becoming more prominent, and consequently things may change in that context. They talk about Carrot Lane, which they acquired in a particular year. This also, I will come back to it in a bit and explain this in a moment. They've talked about the watches business. So they've said premiumization is a play that has been playing, and that's why their margins have gone up from 10% to 15% on this business, right? So not only has there been a growth, and one of the things you can do here is also on a segmental basis, try and find out what is the growth each year. So I can basically calculate growth numbers for all of them year on year and see what these growth numbers look like on revenue basis essentially, and work with them. And you'll spot that there's a reasonably healthy growth that's happening here on watches, which may not just be in gold, you can attribute it to just price increase, but in watches, there is a proper premiumization that is at play. They have cut down on their digital watches business. They hold nearly a 50% market share in the analog watches segment in India. So that's the segment that they have kind of focused on, and that's going up. In eye care, growth in revenue has been good, but the EBIT has kind of declined. So they're still trying to find the correct spot there in the eyewear business. Market share exceeds 50% in the sub 25,000 segment. Focus spans on premium, accessible luxury, aspirational luxury, and absolute luxury. So they've segmented those parts and given to you details about where are they focusing on and what is really going on. And within the 5 to 25,000 segment is where they have their core market share. Then they talk about the vision segment, eye care division, continued revenue momentum, but they were trying to align the property portfolios essentially of what they are selling, and hence the margins have not been very accretive there. The other businesses would be fragrances and accessories and Indian dresswear. These are small at this point of time. They have a B2B subsidiary, which is called Titan Engineering and Automation. That's also generating about 1,500 crore odd of revenue, reasonable EBIT margin. That may grow over a period of time as it kind of becomes important. You can subsequently move ahead and move to the business segments. What is really happening? Where are their plants and manufacturing facilities operating out of? Uh, in the financials, of course, you would want to pay reasonable attention to stuff like management discussion and analysis, where they kind of give you details about each of the segment, number of stores in each of the segment, what's really going on in those segments, what's happening in the jewelry business, and so on and so forth. You also want to kind of look at financial statements. So if you go to the financial statements after you've gone through all of this, I'll just show you, for example, one simple point around your consolidated financial statements and the gold on loan part. And you can identify what is the interest that they're paying on the gold on loan segment as well from that statement that you see. So this is the consolidated balance sheet. You can see all the notes to accounts. Do go through these notes to accounts because they give you an idea. For example, gold on loan should catch your eye and say, what is this 17.2? And then you go further and look at finance cost, which is in note number 24, and see whether that includes part of it on gold on loan. Right. So we go to note number 24. Let's quickly move to note number 24, which is here, finance cost. So you see borrowings have a finance cost. Interest on lease liability is the notional interest. This is the part of rent that got reclassified. That's 247. And gold on loan is basically 320 crore on whatever gold they had on loan, which is about 16,000 crores. 3 to 5% is what they typically end up paying on it during the year. Also remember that your finance cost is through the year. Gold on loan number is end of the year number. So it may have been higher during the year and then brought down towards the end of the year. So that's something that you want to keep in mind when you are evaluating a business such as this. So that's the construct. I mean, eventually you could dig deeper into all of these numbers and try and understand why are the segments moving the way they are, what's really causing the movement in the segments the way they are. But the bigger question you want to answer or ask at least is this why. And almost all of these answers are available in their con call transcripts. If you were to dig deeper to understand how is the business being operated and why is it moving the way it is moving, just keep in mind that this is a very interesting business. It runs a standard competitive advantage of being a large organized player in the segment. And they have this standard playbook that they've used. They have mastered it in jewelry. They're really good in watches. Just that the size of the watches segment in India today is small, but it is growing reasonably healthy pace. I mean, when we see segmental results, you do see that the watches division itself from 3,300 has gone to 5,200. By the way, wearables, which is digital watches, smart watches as a category was not doing very well for them. So they scaled it down and they doubled down on the analog watches business, which has been doing very well. And that's reasonably good double-digit growth with expanding margins. Right. So that's a very healthy sort of a sign that you see that is playing out in the contour of their business. And hopefully over a period of time, this becomes large or larger as well. But their biggest driver will be basically with the purview of jewelry, purely because even with the context of their current size, they are at a single digit market share in jewelry as a segment. And we have not talked about international expansion as such. They bought Damas, which is a major player in the Middle East segment. But that is something that you would want to kind of understand, attribute, look at when you're looking at something like this in a little bit more detail. So that's the construct. Now, what is their real competitive advantage, right? So one is the scale that they operate on. The second is their entire advantage because of the scale and trust that they've built is the movement of the market itself in the unorganized to organized space that exists for everybody, but just the sheer size and scale, like any other business where you are likely to see the Tata name in this case, you are likely to kind of go there. They run very interesting schemes. I mean, within jewelry, for example, they used to run or they continue to run the Golden Harvest scheme, which is where I think, if I'm not wrong, you would go and buy, it's like an SIP into gold. So you buy, let's say, 10,000 worth of gold for 10 months. So you put in 1 lakh. In the 11th month, they put a certain percentage of your SIP. So you have basically put in about 1 lakh rupees over a 10-month period. They add to that. And then in the 12th month, you can go and buy gold worth that much. Now, usually what happens is people have put in, let's say, 1 lakh rupee worth of gold. Titan adds about 5,000 to this. So you get a 5% extra amount, just using a number as this thing in the 11th month. When you go to buy, you end up basically upselling to this customer, because the customer would invariably buy 20-30% higher than what the golden harvest scheme, because when you go mentally and behaviorally, you say 1 lakh rupees already given, right? So might as well buy for 1.2, 1.3, which if you had gone without the golden harvest scheme probably wouldn't have happened. So there is a generic upsell that happens because of these schemes that run. They've also started something, I forget the name of that, which is in grammage. Golden harvest is in terms of rupees, INR worth of gold bought every month, SIP over a 10-month period. But they've now said that you can also buy grammage of gold. So you say, for me, buy this much of grammage of gold every month. And then, hold it over a period of time. And then you basically convert it into jewelry at the final point. So they've broken it down into a mechanism where people would keep buying small amounts of gold every month, and then eventually buy the larger purchase at a later point when it is needed. And consequently, they've been able to sort of upscale the entire segment in that premise. Gold on loan is a big advantage. Other jewelers may not get a gold on loan at 3 to 5% rates purely because of the credit profile that Titan carries in this case. And that is a very, very massive competitive advantage that they carry. And just the sheer point that you're sitting at about 8-9% of market share in the overall jewelry segment may not become 50, but 8 can become 12. And in a country that is with a growing income and rising aspirations, that's a sizable chunk or move that can happen. Please note, we have not talked about valuations. We are not talking about valuations in this discussion. All we have looked at is where is the competitive advantage sitting? How do you look at numbers, and what is the nuance of those numbers when you're reading those numbers? One more point that I wanted to kind of discuss with the numbers. Remember, in ratios, we saw a spike in ROE in 2023, 2024. You want to spot this. Where is this coming from? So two ways to do this. Either you can go and check something called as DuPont analysis. We have another video on that on our YouTube channel. You can explore that out as well. But even intuitively, if I just go and look at the equity number, there was some recalibration of equity that had happened. They are profit making. So technically their equity should not go down, but the equity went down here because this is where the Carrot Lane acquisition was done. So there was some sort of reorganization in the equity at this point because of the Carrot Lane acquisition that resulted in equity dropping, and optically the return on equity number appears to be higher. Then normal process starts after that. You make some profit, some part of it goes in dividend, remaining part of it gets added in other equity. So that equity keeps growing beyond that. Part of the jump that has happened recently is improving margin profile once again and moving it to that scenario. But 37% was a little bit odd as a number that we had seen, right? So that's the construct of this data point. That is all that we had to kind of cover in the financial analysis of Titan. That's it from me in this particular discussion.